Welcome back to another one of our videos. The stock market can be used as a great tool to grow and build your wealth. Having guided thousands of investors, we uncovered the top 5 critical investment mistakes that could be holding your portfolio back. In this video, we'll discuss these 5 mistakes. So the number one mistake that we see investors do is chasing returns, i.e. looking in the rear view mirror and believing that something that has happened in the past is going to continue. Now imagine if you are driving and looking in the rear view mirror of your car. Probably you're going to have an accident because the road ahead is not like the one that was just went past you. So what investors do is they often buy stocks, buy asset classes that have gone up tremendously in value, and similarly they avoid asset classes that have gone down a lot in value. 2 most recent examples of this type of behavior was between March of 2020 and February of 2021, Chinese stocks went up over 100%. What we saw then from investors is they wanted to actively buy Chinese stocks after they went up, as I say, over 100%. What happened then is over the next year and a half, from February of 2021, Chinese stocks actually fell by 70%. A more recent example of this type of behavior was we saw this in 2023. So in 2022, as you know, the Federal Reserve increased interest rates. A lot of growth companies fell precipitously, but the stocks which did well were value stocks. Companies like McDonald's, companies like Coca-Cola, dividend-paying stocks. What we then saw is in 2023 is once again, investors looked at the rear view mirror. They said, well, these stocks have done very, very well in 2022. Let me allocate most of my funds towards these dividend-paying stocks. And what happened subsequently is they missed out on tremendous returns in growth and technology stocks in year 2023 and 2024. So the number one mistake that we see investors do is chasing what has worked in the past and assuming that that is going to continue to go up. The second mistake that we often see investors do is having a portfolio that is not properly diversified. Having a lot of stocks in your portfolio does not mean that you are properly diversified. For example, your portfolio might be composed entirely of the Magnificent 7 stocks. That does not mean you are properly diversified because, for example, in 2025, those stocks fell almost 30%. So you need to have a portfolio that is well balanced. When some things in the portfolio are going to be decreasing, for example, in 2025, it is the high growth stocks, the Magnificent 7 stocks, you need other things in the portfolio to counterbalance that drop. Things like gold, things like treasuries, things like private equity, things like private credit. So a lot of investors are not well diversified, and when the stock market drops, they are simply exposed to one particular sector, and that can have drastic repercussions for their portfolio. The third mistake that we often see investors do is trying to time the market. Now, this mistake often applies to people that often check their portfolios multiple times a day or even once per day. These are the type of investors that often react on headlines, and when the headlines are bad, they sell their stocks. When the headlines are good, they buy stocks. The problem with this type of an approach is nobody knows where the bottom is going to be in the stock market. By the same token, nobody knows where the top is going to be, not even Warren Buffett. Similarly, if you think that the stock market is going to go down and you have predicted that and you have a high level of confidence in that, not only do you have to get the sell decision right, but you also have to get back into the stock markets. So they could have been smart investors which predicted, for example, the financial crisis, that predicted the COVID pandemic. They sold potentially a couple of months before that happened. But the next decision which you're going to have to do is you're going to have to buy the stocks back. Okay, that is often a very difficult decision to be able to do. And we know many investors that didn't buy the stocks back in 2007, and many investors didn't buy stocks back in 2020. So an important saying is time in the market is much more important than trying to time the market. The fourth mistake that we see investors do is trying to get rich quick schemes. Investing versus gambling. Investing is more of a longer term time horizon. As we know, stocks annualize at about 10% per year over the long term. Gambling involves things such as options trading, buying securities on margin, or day trading. It is virtually impossible to achieve these high returns, 100, 200% returns in a single year, year and year and year out. As a result, what often happens is these people might get lucky once. They might have a strategy or a stock that has gone up astronomically, but when they try and replicate that strategy, they often potentially are able to lose their entire investments. For example, in options trading, you can make multiple times of your money, but if you get a particular decision wrong, you might be able to lose 100% of your capital. Similarly, when you are buying securities on margin, you are borrowing capital and you often might be forced to liquidate the security at exactly the wrong time. Okay, so the key to investing is letting your wealth compound, grow over time. Think over a longer time horizon, years, possibly even decades. And the last investment mistake that we see investors do is investing in hot stock tips. Okay, investors do not spend enough time in analyzing the stock which they want to purchase. They might simply hear of a stock on their way to work in a bus. Somebody tells them to buy a particular stock, or they might hear of a stock on the radio. They might hear of a stock on CNBC, and they plow a large amount of their wealth into a single stock which they have now done no due diligence on. Think about it this way. When an investor is looking, for example, for a new car, what they do, they take their time. They go to every single car dealer, they take a test drive, see how the car drives, they do their research, they calculate how much the car costs, how much do they spend on gas, how much is going to be their insurance. So they take an approach which gets all the information together before making their decision. Now, what investors do in the stock market, that they try and skip all of these steps and they simply buy the stock which they mentioned. Now, examples of this recently, for example, was GameStop during the COVID pandemic. That stock went down a lot because there's no fundamental basis behind it. More recently, we saw a lot of quantum computing names being in the news, and those stocks went up precipitously. By the time you hear of a stock on CNBC or on the radio, most of that move in the stock has largely been done. Okay, so most likely you have to do a lot of research before you decide to purchase that security, if that security is the right fit for you. So I hope you guys enjoyed this video about the top 5 critical investment mistakes that we see investors actually do in practice. Please give us a thumbs up on our videos. Please follow our channel and visit us on advisormanageportfolios.com. Till next time.